The national debt has reached an unwanted landmark, passing £2 trillion.
The UK government was expected to spend about £850 billion this year. As a result of the COVID support that's being provided, it will spend a lot more than that, at least £200 billion extra. But the final amount will depend on whether extra support is needed towards the end of the year. £850 billion is a lot of money. As a percentage of all the income that's generated in the UK in a given year, something we call GDP, government spending would usually be around 40%. COVID spending, by pushing incomes down and government spending up, means this will grow to over 50%. This raises an important question. Where does the government get this money to spend?
There's a saying that only two things in life are certain: death and taxes. And taxes are the main answer to the question. Before COVID, taxes, plus a few other sources of revenue, were providing the government with around £815 billion a year. That's almost, but not quite, enough to cover the amount that's spent. We call this shortfall between spending and taxes the budget deficit. The pandemic means the amount the government raises in taxes will be lower. For example, less will be raised from income tax and VAT as people work and spend less. This increases the deficit. To cover the deficit, the government borrows. And that's the second part of the answer to the question. The government gets the money it spends, in part, by borrowing. You might expect the government to swing between running deficits in some years and surpluses in other years. But actually, deficits are the norm. Since 1948, the government has only run a surplus, meaning it raised more money than it spent, in 12 years. And it's run deficits in every year for the past 15 years. Now, if you or I were borrowing a lot, we'd worry. So should the government worry? At the start of the year, so before the crisis, government debt was around 80% of GDP. That's 80% of the total amount of income produced in a year in the UK. Because of COVID, it's likely to jump to over 100%. Now that's high by recent standards, but it's actually nowhere near the highest peaks we've seen historically, typically around wars. So to know whether the government should worry about high debt, we need to answer the question, how are they going to pay back that debt? And to do that, we need to break things down a little.
The government is not like a household, which would typically borrow through a bank. The government, because it's a large, trustworthy borrower, which is expected to be around to repay, is able to borrow directly on financial markets by issuing bonds. Bonds are just contracts. They say how much the government will receive from an investor today and specify how much will be paid back and when. Some large companies can also issue bonds. The advantage is that investors can compete to lend to the government, and that keeps borrowing costs low. The UK's Debt Management Office, or DMO, carefully chooses when and on what terms to borrow in order to get the best possible deal for the government and to make sure it repays its debt when it comes due. But COVID-19 meant the economy entered lockdown very quickly and sharply, and the government had to immediately try and provide economic support in April and May. It may not be so easy for the DMO to suddenly issue all these extra new bonds. There might simply not be enough people who, at a reasonable price, want to buy them. In such a situation, the government can use cash it already has in its bank accounts held at the Bank of England. Or, if necessary, it can use an overdraft facility at the Bank of England, which is called the Ways and Means account. If used temporarily, the DMO could later issue government bonds. If the Bank of England can provide these loans, you may also ask why it can't just print all the money needed. The problem with printing money is that if you print too much money, you will generate inflation. And while inflation may not be problematic at low levels, at high and volatile levels, it is very damaging. To prevent the temptation of governments simply running the printing presses to finance all their spending, most countries separate the central bank, which controls the supply of money, from the government, which decides what to spend and tax. This means that although the central bank purchases government bonds, as it has been doing as part of its quantitative easing or QE policies, it does this to help control inflation. It doesn't purchase bonds directly from the DMO, and it can choose independently when and how much to purchase. This independence of central banks has helped keep inflation low and stable over the last 30 years, And low and stable inflation actually reduces the interest rate that government has to pay on its debt, leaving more resources for other spending.
But, you may say, even at relatively low interest rates, surely we can't keep building up debt and then paying back debt with more debt. Ultimately, don't we need to raise taxes, cut back spending, or a bit of both? That is one possible way to attempt to reduce the debt burden. It was the approach taken by the Conservative and Liberal Democrat coalition government in what has become known as austerity. But, for much of history, governments have taken a different approach. In spite of nearly always running a budget deficit, we've regularly managed to reduce the burden of debt. The secret is economic growth, specifically economic growth that is greater than the cost of debt interest. As the size of the economy grows, the relative size and therefore importance of the debt pile gets smaller and easier to pay down. This is one reason why austerity can backfire. It can reduce the size of the economy and increase the burden of existing debt. And this is one very important reason why a temporary build-up of debt in order to keep the economy going in the face of a crisis is no bad thing. We don't want to allow too many companies to close or too many jobs to be lost. We want to keep the economy moving and ensure that in future we can, like historically, grow our way out of debt. So, where does the government get its money? It comes mainly from a range of taxes and is supplemented by borrowing. Our national debt pile can be directly reduced if government raises more in tax than it spends, but, as has been the case historically, debt can also be managed by ensuring that the economy grows and that the debt simply becomes less important.